All right, good evening, everyone. Look like we got a couple more people who have signed in. So we're going to go ahead and start. First, we're going to do a little bit of housekeeping. My name is Glenn Thomas, like I said earlier. I'm the reverse mortgage sales manager here at ERS. And we're going to go over and talk about reverse mortgages today. All right, here's a training calendar. Just a quick recap. Monday is the 10 o'clock is the Robert and corporate call from 10 to 11. We also have insurance training that night. Tuesdays is mortgage and real estate training. Wednesdays is home services. And Thursday is the corporate training and recruiting event. So all you have to do is go log into the drive, and you'll be able to see all the training that's going on. And this just talks about how to access some of the existing videos. You go into the Google Drive, and you go under Elite Mortgage Training Videos, and you can pick the training that you would like to look at. And all the trainings are listed under date. So anytime you're looking for a training, just go under, look at the date that the original training was conducted, and you'll be able to pull it up via there. All right, this is something that we have a training syllabus. And this is really for our new incoming loan officers. You can go look at the syllabus and see everything you need to do to jumpstart your training. And you know, I believe it's every 6 weeks, Kevin rolls out a new hire training. So like I said, once again, check the training syllabus in the calendar for all that information. And here's the contact information for our mortgage department. So if you need to, if you have a loan scenario you want to talk to someone about, you can call in there. But remember, always the best option, contact the AE for the lender you're going to submit it to. That way, you know you're getting most up-to-date information, because things are always changing. Each lender has different underwriting guidelines that change, so call the lender direct. And you know, once again, here's an example how to get into the Google Drive. Back to me again. All right, so we're going to go ahead and start the training. And like I said, any questions, to type them in the chat box. Have everyone muted. If you need to be unmuted, if you have a question you want to share with anyone, just type it in there and let me know. The only thing I ask is that you have your background muted, or you don't have background noise. If I unmute you, you know, I don't want a lot of back talk coming over. All right, so we're going to reverse mortgage sales training. And we're using our partner, one of our partners, Urban Financial. We're using some of their training. Very in-depth training. And I'm going to incorporate with some real-life examples so you actually be able to see examples of things to do and things to look for. And if you have any type of questions, that's our AE, Adam. Real helpful. A lot of information. Any scenarios that I might not know or don't know the answer to, I'll call Adam, and he'll walk me through it. And like I said, we have right now we have 5 lenders on the reverse side. Currently, that's on the DBO. On the BRE side, we have 2, and we're constantly adding more over there as well. So anybody that's BRE, if you want to do it, you can do it. You just need to let us know, you know, whether you BRE or DBO, so we can tell you which lender you need to submit it to. All right, what is a reverse mortgage? The correct name is called a HECM, Home Equity Conversion Mortgage. And what it is a FHA loan for seniors that convert home equity into tax-free money. So unlike a lot of other avenues where they pull the money from, it can be taxed, this is untaxed. So they can pull the money out and don't have to worry about paying any type of taxes on the money. You can use it to pay off your current mortgage or any outstanding debts that you might have. There's not any limitations on what you can use this money for. It's your money to use how you please. Once again, it provides the borrower with tax-free money to use however he or she chooses. You don't have to repay until the last surviving spouse or borrower permanently moves out of the home or passes away. At that time, the estate has 12 months. And the big thing about that is with a conventional mortgage, your estate, they're going to have about 2 months to pay it off. And any other debt that is out there, it can be attached to the home and frees up other assets. So if they have money in the bank or any other type of payments coming in, the lender can access those accounts, can freeze them. So good thing about a reverse mortgage is non-recourse, meaning that even if you're underwater, you could have $1 million in the bank and you owe $200,000. Guess what? Your money in the bank is safe. The FHA insurance is going to pay it off. So it's definitely a good tool for financial planning to protect your estate and avoid costly probate charges and things like that. All right, everybody must be 62 and over. We do have a program to where if one of the spouses is under the age of 62, you can still get the reverse mortgage, but it's going to limit the amount of money you can get, because the whole purpose of the reverse mortgage is to allow the last surviving spouse to stay in the home until they pass away or they decide to sell it. So if you're 66 and you got a 30-year-old wife, you're going to limit how much money you can get. So, so you need to know that. All borrowers must be U.S. citizens or legal residents. So, it's open to pretty much everyone. Biggest thing, they're insured by FHA and HUD, meaning that if you go underwater, your assets are safe. Example, you do a reverse mortgage and you owe $500,000, but the house dropped in value and now is only worth $400,000. The extra $100,000 is going to be paid by FHA insurance. So none of your assets will be seized or taken. So like I said, that's a big thing for our estate planning, because you don't want to leave a tax bill to your family. This is a question that comes up a lot. Can I get it on my second home? No. Only your primary residence, meaning you have to live in the home. You have to live in the home for more than 6 months. You can have second homes, you can have vacation homes, things of that nature, but your primary resident must be the home that you get the reverse mortgage on. And the whole purpose behind the reverse mortgage is to help you stay in your home. So if people are just getting them on their vacation homes, pulling out money, then it's going to drain the program. And that's not the purpose of it. The purpose is to keep seniors in their home, because there's been many studies, the longer you stay in your home, the longer you're going to live. Normally when people move out of their home, when they're older and downsize, they tend to pass away quicker because they're not in the same familiar settings. They have to go through changes, stress level kicks up. So the whole program is designed to keep people in their home. Like I said, owner occupied. And here's the thing, all borrowers must attend counseling. Counseling can be done over the phone. It takes between 30 and 60 minutes to do. It's a minimum fee. And once you have counseling, then you're able to move forward in the process. And one thing I always like to tell people, if you're working with a client and they want to do the reverse mortgage, have them do their counseling up front. Before you start doing all your footwork, have them do the counseling, because if you go ahead and get them to get on application and you do all this work and they decide, I'm not going to do it, you've already expended time and resources. Have them get the counseling, because it's mandatory. We can't change it. And what it does is it gets them moving. All right, principal limit. The principal limit is based off the age of the borrower, or the youngest borrower, and the value of the home. So if your home is worth $500,000 and the youngest borrower, say, is 65, they might be able to borrow about $257,000, $206,000. So they preserve an equity in the home, because the equity needs to be in the home to take care of the interest payments, because the interest is charged just like a regular mortgage, but it's deferred to the end. So they have to leave equity in the home, because people always say, well, I have a $600,000 home, why can't I borrow $600,000? Well, you can borrow $600,000, but you're going to have to make monthly payments, because the bank or FHA is not going to insure that loan, because they're guaranteed to be underwater. If you're accruing interest on a $600,000 loan and you live in it for 20 years, that's a lot of interest to come due. So there must be equity in the home. And some people say, well, can I make payments on it? Yes, you can make payments on it. So people can always make payments to pay the interest down if they choose to. You know, I don't recommend it, but that is an option, because I always tell people that money you can be paying towards the interest, you can pay it towards annuity, other investment devices, or you can buy insurance policies. Something that's going to guarantee your family some type of income, because if you're making those mortgage payments, who's to say the property value is not going to drop? And you've been making all these mortgage payments, and they still have to file an insurance claim. But if you get an insurance policy to cover you for the balance of the loan, then they're guaranteed to get that tax-free money off the insurance policy. Maximum claim amount. Person has an $800,000 home. FHA limit is $625,500. So if you have an $800,000 home, they're only going to look at the first $625,500 at home. Everything else is your equity. So that's still going to be in there. That's still your equity up at the top. But you can borrow up to $625,000 towards your principal limit. And then your max claim is going to be based off the age of the borrowers and the value. So $625,000, you're 70 years old, you could probably borrow about close to 69, 70% of the value. So it does give you money out of the home, but it does maintain the equity in there. All right, and we're going to look at the max claim. Here's an example: $450,000, maximum lending limit $625,500. So the maximum claim amount they're going to let you borrow is $450,000. Example 2: $1 million home, maximum lending limit is $625,500. The most they're going to let you borrow is $625,500. And like I said, the reason being that FHA has a lending limit, just like on the forward side. There's a lending limit that FHA is going to loan up to. Anything over that is a jumbo. So same with this, we do have jumbo products. If you have a home valued at $1.5 million or above, then we have a product that can give you a little more cash out. So there's always options, and lenders are coming out with different programs to meet the growing needs, especially in California. We have such high home values that the $625,500 is missing a lot of people. You know, they might be valued at about $900,000. So between the current jumbo and the lending limit right now, there's a bunch of people who's missing out. So there's new products coming out. Like Urban, they came out with their jumbo, which covered a little bit of that. But now AAG and some other lenders are coming out with new products. So as they come out, we keep you updated on those changes as well. All right, like I said, we talked about the counseling. Counseling is mandatory. It's going to cover the reverse mortgage. Make sure you understand what you're getting into. The biggest thing is they want to make sure you understand you're getting a loan. They want to make sure you are mentally capable of making a financial decision on your own. And if you have a power of attorney, then your power of attorney must go through the counseling. So it's there to make sure that people are understanding, and with so much elder abuse going on in the past, they have to have some type of third party there to protect those people. And you know, sometime here in California, we have a 7-day rule where once you get counseling, there's a 7-day moratorium where we can't do anything. We can't run credit, we can't do anything until that 7 days is passed. It's called a cooling off period. So that's another thing. That's why you want to get them in counseling first. That way, once that 7 days is up, you can go running with the loan. Perfect example, I'm doing a loan right now. We went, she did her counseling that same day that I went down there to meet with her. We did all the paperwork. As soon as 7 days was up, we ordered her appraisal. We ordered her credit and her SMUD. I mean, not SMUD. We ordered her credit and her flood cert. So now, only thing we're waiting for is the appraisal to happen. And once we get the appraisal back, we have all the documents already. We're ready to go. And what I'm probably going to do is I'm probably going to mix in another slide here because this is more technical.
Does the cooling off period start after you receive all the documents?
Okay, question was the cooling off period. Where does the cooling off period start? Cooling off period is the day of counseling. So the day they have counseling is 7 days from there. So before that, so perfect example with her, she gave me all her documents. And I had our documents, had her income, her mortgage payment, I had everything. So I got all her documents. The only thing I didn't do, I didn't put her credit, and I did not get a flood cert, because anything that she's charged for, I can't do. I couldn't order the appraisal. But what I did was, there's a sheet that we have for the financial assessment, and that's a later training, where I sat down with her. I said, okay, let's go through your finances. You know, what do you have going out? What do you have coming in? And we just went through this sheet, and I pretty much pre-qualified her. And like I said, that's more of a later chapter, the financial assessment, because that's another thing that came out this year. They wanted to make sure that people who are getting these loans are able to maintain their required payments. And the payments are, you have to maintain your homeowner's insurance, and you have to keep your property taxes going. So in the past, people were getting reverse mortgages, and they didn't have the resources to pay that. And what was happening was people were going into foreclosure because not having their paying their taxes. So did I answer your question for you?
Yeah.
Okay. Mm-hmm. All right, common misconceptions. Reverse mortgages are for desperate seniors, the last resort. On my other slide, there's the biggest reverse mortgage ever done in history. I think it's on a $72 million home in Bel Air, California. So that's not a last resort. He pulled out money because, once again, he had this equity. He wanted to give it to his family, so he did a reverse mortgage. I've done a reverse mortgage for this guy. His house was valued at $800,000. He had no payment. He did the maximum lending limit. So I think he was able to pull out $400,000. And what he did was he dispersed it to his grandkids, because he wanted them to have the money while he was here. He wanted to see them enjoy it. And you know, we talked about, his whole principle was he believes in a dying broke principle. And the meaning is, while he's here, he wants to share his resources with his family. Give it to him while he's here, let them enjoy it. Not have to pay taxes on it on the back end, or enjoy it while he's gone. He wants to see his grandkids buy houses. He wants to see his kids come out of college without debt. So he used it as that. Okay, the home must be debt-free. That's not true. This is perfect for people who have mortgages, because you get rid of that monthly mortgage payment. Like, go back to the example, the one I'm working on now. She has a mortgage of $300,000. Her mortgage payment is $1,500 a month. She's doing a reverse mortgage to get rid of that $1,500 a month, because she wants to start saving, put more money in her savings again, because she depleted her savings. Even though she has good income coming in, she knows, I'm never going to pay off this $300,000 loan. She just did it two or 3 years ago, and she's 69. What's the chances of her paying off that 30-year mortgage? Chances are slim. So she wants to alleviate the mortgage and use that money. She's buying, I think she said she's going to buy an insurance policy and do other investments with her money. So the home does not have to be debt-free. Oh, when the reverse mortgage comes due, the bank sells your home. Another misconception. The bank does not take title in a home. The title stays with the borrower. Let me repeat. The bank does not take your home. The bank is just a lien holder, just like any other mortgage. Except for the reverse mortgage, like I say, your family has 12 months to take care of the issues, versus a conventional loan where they only have, 2 to 3 months. Okay, cool.
Sorry. They have 12 months to liquidate the amount they owe?
Yes, they have 12 months to make a decision. Either they can sell the home or they can buy it back. And if they buy it back, they can buy it, I believe, it's 95% of the value, appraised value. Because what happens is, let's say both the last surviving spouse passes away. FHA is notified. FHA is going to send an appraiser out to appraise the home. And they get the appraised value, then they can either buy it back, like I said, 95% of the value. They can sell it in any equity, they can keep it. But the only thing is they have to sell it at the appraised value. Let's say they wait until 11 months to decide if we're going to sell it. They're going to put it on the market, and if it's not selling, then they can go to FHA and say, hey, it's not selling at the appraised value, Can we lower the price? FHA is going to look, as long as it's with a realtor, a licensed real estate agent, then they're going to go ahead and probably lower the price to sell the property. Because FHA doesn't want to be in the business of owning homes. We all know that. They don't like holding on to inventory. You know, I'm sorry?
But they can sell it for more.
Yeah, you can sell it for more. If you sell it for more, yeah, so if they sell it for more, if the appraised value is more than what they owe, like I said, the bank doesn't share in your appreciation. So that's the biggest key. Whatever appreciation you have is yours. The bank doesn't share in it. Okay? You know, the bank owes your home when you take out a reverse mortgage, no. Your heirs get the debt when you're gone. No, because it's non-recourse. They don't get it, so you don't have to worry about that.
Sorry, going back.
Mm-hmm.
So you said the bank does not share any appreciation.
Correct.
Meaning, if you sell at the face value or your appraisal is $450,000, and you sell it for more.
Okay, let's say the appraised value is $450,000. You owe $200,000 on the reverse mortgage. Okay, you sell a house for $300,000. You pay off the $200,000. I mean, excuse me. You sell the house at $500,000, so you sell above the appraised value. So you sell it for $500,000, you owe $200,000. You pay $200,000 to the bank. The $300,000 stays with the heirs. We flip it, the appraised value $450,000, but it's not selling. It sells for $400,000. The bank writes off the $50,000 to the insurance company, and the heirs walk away without owing it $50,000. You know, in order to be eligible, you got to be 62, have a valid Social Security number. You know, however, non-U.S. citizens without lawful residency still are not eligible. So if they don't have a Social Security number, there's nothing we can do. They got to have a Social Security number. You got to be the primary borrower. You got to occupy the property, be on title, and receive counseling. All right, these are the properties that are eligible for it. Single family. You can get 2 to 4 units. So you can get a duplex, triplex, or a fourplex. And it doesn't matter. Long as it's FHA approved for a condo, you can do it. You know, some manufactured homes, log cabins, as long as there's unique properties that can be financed comparable. So if you have a log cabin and you want to get a reverse mortgage, as long as we can find some comps, we can do it. So, like I said, the program, people say, oh, you have a manufactured home, you can't do it. That's not true. As long as it's a manufactured home that has not been moved and is bolted down, we can do a reverse mortgage on it. You know, ineligible. Investment properties, vacation homes, properties with illegal units, or mixed-use properties with 25% commercial. So, if it's 25% of your home is being used for commercial, you can't use it. So you can't have your home business, but as long as it's not taking up 25%. But a bed and breakfast, you can't do a bed and breakfast. Co-ops, those don't work because you don't actually own it. A co-op, you don't own it. You don't share the heir. Here's a good one. New construction without certificate of occupancy. We're going to talk about this in purchase. So if you're doing a reverse of purchase on a new home, you get the counseling up front, but you cannot get an application. You cannot start your application because if you get an application on a home that's new construction or have a certificate of occupancy, loan is denied automatically. And that is a big thing. You don't want to go in there and be gun-ho and say, hey, I got the person buying a new home. We're ready to go. They're going to be closing in 3 weeks or whatever when we get the application. No, you have to wait. Those go a little quicker when they're new construction. They're going to go a little quicker as they understand that. But you have to have a certificate of occupancy. Because if you don't have a certificate of occupancy, it's not a home you can actually legally live in. Does that make sense? So even though you see it being built, you know it's about to be built, that's fine. They must get the certificate of occupancy. That date must be before the case number, before the FHA case number is pulled. Because if your FHA case number is before that date, they cannot do a reverse mortgage for 6 months because it takes 6 months for that case number to drop off. And like I said, I lost a deal years ago behind that because we waited to do it, but someone else a few months earlier pulled a case number, and that case number was locked on it. The person didn't realize this person did a case number on them, and when we went to go do it, the old case number took precedence over my new one. So they weren't able to do it. Manufactured homes that are condos, and really not a big issue here, single wide manufactured homes. Really down south a lot, you know, you have the double wides, you know, we do have them up here, but really down south you have a big issue with those. So, but those single wide can work, but a double wide will work. All right, and actually let me try something. Give me one moment, okay? Yeah, can you plug in real quick? So what I'm trying to do, I'm bring up another slide, because these slides I want to. Okay, what we're going to do is I'm going to continue with this one, but I'm going to bring up another one shortly, because I have another one that goes a little more detailed. It's not as technical as this one, so I want to go with that one. Okay, so the way the property can be vested, it can be vested in numerous ways. It can be fee simple, land estate, leasehold, revocable living trust, and land trust. So there's a lot of different options. So however the property is titled, there's options to get it done with a reverse mortgage. So don't only think about a trust or any of these other things. As long as you have every page of the document, get that up front. Get it in and get your trust approved by title and everyone else up front. So that way you won't have any surprises at the back end. You know, I use my past history. Someone gave me a trust, and I just saw these pages. I said, okay, it's a full trust. I sent it in. They kept kicking it back to me. It's not a full trust. I'm like, it is a full trust. So then I looked at it, and then I went and sat down and talked to my borrower. I said, hey, they're saying it's not a full trust. She said, oh, you need the whole book? So yes, yeah, I need the whole book. So then we got the full trust, 100 some odd pages, scanned it, sent it over, then it went right through. So as long as you have all the documents, you know, thing about these loans is FHA insured, and with all the new guidelines, everything must be documented. Income, everything must be documented. So as long as, you know, most of us, we've done forward mortgage, so we know about steps. We're not scared to ask for documents. You're not scared to ask for tax returns. You're not scared to ask for W-2s and other income. You're not scared to ask those questions because you know the underwriter's going to ask them. So you're going to have to jump on most people, a lot of people doing reverse mortgages, because they're still kind of scared to ask those questions because they hadn't had to ask them in the past. But you know, if you ask a person, they understand this is not their first time in a rodeo. They got a mortgage. They've done a mortgage already. So they expect you to ask for these items. So ask for them with confidence. It's always better to get more than less, because you never know. I have underwriters. I have one underwriter who made me source a $1,000 deposit, and the lady had over $100,000 in her account. But I had to source a $1,000 deposit, and she was getting money back. And she said, "Well, I don't know where this $1,000 came from. I just get money from different sources." I mean, she had a good problem. She getting $1,000, she don't know where it come from. That's a good problem. But you know, we got her bank accounts, and she remembered, oh yeah, this is a check. I got this from one of my accounts, a dividend check. So okay, show me the statement that came out of. We send it in. So more is always better. All right. It does not affect your Social Security or Medicare, but it can affect other benefits. So you need to talk to a professional financial planner. If they have any questions about the effects that it might have against their Medi-Cal or anything like that, have them talk to a financial planner. Don't get involved with that, because you could be liable for giving bad information. You know, I'm not a lawyer. I might play one on TV, but I don't give out legal advice. So always refer them to a professional. And a lot of times you might want to partner up with professionals who you have resources that you can point them to. And like I said, I cannot stress that enough, because I saw a deal where a lady was about to take a lump sum of money, drop it into her account, and then the guy who was doing the loan, he said, well, have you spoken to anybody about this, about your different benefits you might get? Well, I should be all right. He said, well, no, go talk to somebody. Come to find out, it would have affected her benefits. If that large sum of money would deposit into her bank account, she would have lost certain benefits that she had. So what we did was we structured it in a way to where she can get it in small portions and not affect her benefits. So those are things that you have to look for. Because like I said, you don't want to be the one who costs the person their Medi-Cal benefits. You don't want to be that person. You don't want to be it at all. All right, so there's a couple different products. We have the fixed, which the fixed is like it is, it's a fixed rate. That's the rate they're going to get. It's not going to change. The only thing about the fixed rate, you got to remember, they get one draw. So if they have a large mortgage, I say go with the fixed because no origination fee. So that way they get maximum cash because they only get one bite at the apple on the fixed. Then we have the ARM. And so they either do a monthly, where the interest rate changes monthly, or annually. All right? The difference is you do monthly, you might make about half to 3/4 more of a point on the back end. Or you do the annual. I always do the annual because with the annual, it caps at 5%. So if you do a monthly, it can cap at 10%. And one thing we always stress is let's do best what's for the borrower, okay? Is it better to give them a loan that's going to cap at 5% over their initial rate, or 10% because we're going to get maybe a few extra $100 in our pocket? How many referrals do you think you're going to get? And if you get called before the DBO or the BRE asking them, well, why you picked this loan? What are you going to say? Oh, because I got paid more commission? So always do what's best. With Kevin, Wynn, and I, we always talk about, we want to be the low price leader in this. So the margins that we're going to do are going to always be less than everybody else. Because guess what? We'll take less money on the back end. I'll take less money on to get 2 loans versus more money to get 1. Because what's going to happen is when you sit across from your borrower and talking to them about this, they need to feel that you're looking out for their best interest. If you're looking out for your pocket, you probably want to stay with forward mortgages because you get a lot of time is invested in these clients. Today, Silviana had a little rolling joke about me for the last couple of weeks. I have a client, Miss Betty. Miss Betty only wants to talk to me. She doesn't want to talk to a real estate agent. Only want to talk to me. She's doing a purchase. And so Silviana sent me a picture a couple weeks ago. So I had to take Betty to the bank because Betty doesn't drive on the freeway. And so she sent me a picture of Morgan Freeman driving Miss Daisy around. And so she said, I'm driving Miss Daisy. And today I had Betty again, and I told Silviana, I said, guess what? I'm driving Miss Daisy today. So we had to go to the bank and wire her funds in for closing. But one thing about it, Betty is going to call me months, years after this loan close. Anytime Betty talks about me, she's going to say nice things about me. I still get calls every now and then from clients from doing loans before. Call and ask me a question. Because you have to invest the time. You actually have to care about these people you're working with. So if you're in it just to get a quick dime because you see, I can make this many basis points, you might make one, but the people are going to see it. So you got to really care and want to help people. Like I said, I've been listening to Zig Ziglar a lot lately. And his whole thing is, if you're not trying to help people, then you're not going to be prosperous. So the more you're helping people, the more you're going to help yourself in the long run. So take it or leave it. That's my point of view. Take them for purchase. Like I said, you can use it to buy new homes. We're starting to do a lot of marketing towards realtors, letting them know, hey, you got these clients who's selling house and they got all this cash and they're about to pay cash for a new home. Why pay cash? Why tie your money up in that home when you can get a reverse mortgage and keep half of that money in your bank and use it to live off of? They also got draw restrictions where they're going to limit themselves how much money they can actually pull out, because they might have a tax account, a set aside account. So there are different options. So here's like say on both the fixed and ARM product, the most they can pull out during the first year is 60% of the principal limit. And that was put in place a couple years ago. You used to be able to pull out all the money up front, but then they found that a lot of people weren't used to having that much money. If you never had money and all of a sudden you get a check for $250,000, that $250,000 is going to go pretty quick. And then you're going to be in a situation 3-4 years down the line, you're not able to pay your taxes and insurance. So what they did was they said, hey, you're going to get $300,000, but guess what? We're only going to give you 60% of that the first year. We're going to give you 60%, and we're going to leave the other 40% on the line of credit, which you're going to get a growth rate on it. So it is going to grow, but you can't get it for 12 months. You know, a lot of people saying, well, why you want to hold their money? That's not fair. Because one, it dropped our commission. Because instead of getting paid commission on $300,000, you're now only getting paid commission on, what is that, $180,000. So a lot of people say, oh, you're killing us, you're killing us. But no, I mean, I've talked to clients who did reverse mortgages and they blew all the cash and they were trying to refinance to see if they can get any more equity out of the home. You know, a lot of times when people get a lot of money, you have a lot of new family come around these people. And, you know, everybody got a sad story. Oh, I need this, I need this. So they limited them that first year to let them get over the initial shock. And in the second year, normally they're a lot better with their money. So here's an example. $100,000 principal limit. Mandatory obligations is $40,000. So they can pull that 60% out, and so they get $20,000 available cash to them. So, you know, so they still get cash. They're paying off all their mandatory obligations. All right, and this is draw restriction. So, like I said, once again, you got an example of $100,000. Mandatory obligations $65,000. So that's 65% of the principal limit. That's over the 60%. So what they did was they give them a $10,000 of the principal limit above. So that drops them, but then the 60% is $60,000. So even though in this scenario they're over it, the borrower is still entitled to 10% over at closing, so they're still going to get $10,000. So if they have a big mortgage on there, and that's why I said with the fix, if they have a large mortgage, let's say the principal limit they can borrow is $200,000, and they have a mortgage that's $180,000. Okay, give them a fixed rate. That's pretty much all of it right there. Then they're going to get the additional 10% over that. So it might take them up to about 98% of what they're able to get, but that's their one-time draw. Versus giving them an adjustable where you're going to charge them $5,000 in origination fees, and they're still only going to get the same amount of cash. So once again, you have to think and look out for the client's best interest. You know, because some people say, well, I don't want to do, I'm going to give all fixed rates because these people, they don't like adjustables. They know how it can shoot up. Well, if you do all fixed rates and they audit you, okay, why are you only giving fixed rates? And the good thing about counseling, when you send a prospective customer over to counseling, you have to send a proposal, which you recommend to them. If you have in that first category an adjustable, guess what that counselor is going to ask them? Did they tell you about the fixed rate? Why aren't you getting the fixed rate? And if you haven't talked to your borrower about that, they're going to cut the counseling short and say, okay, you need to call your loan officer and have him or her explain to you about the other options. So you need to educate these people in everything. What's the name? The fixed rate versus the adjustable. You know, fixed rate, will soon offer the same payment as the ARM product. Hasn't come out yet. So still, you get that one-time draw. It's a fixed rate for the life of the loan. Line of credit, monthly payment, and cash draw, all available options 12 months after closing. This hasn't come in effect yet. This hasn't come in yet. I think FHA put a freeze on it because FHA wants to make sure that before they release this new change, it's not going to affect the equity that the borrower is going to be charged. Because what I always tell people, sometimes when people say, I want the fixed rate, I want the fixed rate. Well, okay, why not go with the adjustable? Let's say we put you on the adjustable and we give you a margin of 2.25 and your initial interest rate is something like 2.3. Why not ride that 2.3 interest rate for the next 5 years, 6 years, and if it does go up a little bit, so what? You've maintained equity over that time period before your interest rate goes up. But if you go with the straight 5% interest rate across the board, it's eating up more equity. So those are things you need to look at. And that's why I'm saying when you do the annual adjustment, you know they're going to be on that same rate for a whole year before we have any type of adjustments. And, you know, so like I said, the adjustable, you got the monthly adjustable based on the LIBOR or the annual. And so they can get the line of credit. Here's a good thing too, they can get 10-year payments. Pretty much at the time we do the proposal, it's going to say, okay, they can get this payment for the rest of their life. There's a life expectancy chart that it goes off of. They get that payment. So I don't know what the life expectancy chart is. It's something, it's an insurance type thing.
Tell them when they're going to die. I'm sorry. That's gonna say.
Pretty much the life expectancy, you know, the average male or female, it just goes off the average person because it doesn't determine, it's not determined off sex. So it's the average person. So let's say life expectancy they have is 86. I don't know, it's a number they don't tell us. Say it's up to 86. But if that person lived to be 96, guess what? They still get that same payment. Doesn't matter. So that's tenure. Or term. This is one where a person might have some type of annuity or something that's going to mature in by maybe 5 years. So they need a payment to cover them for the next 5 years until the new payment kick in. So they can say, hey Glenn, I need a payment of $1,000 for the next 5 years. Okay, I go in there and figure it out. Okay, you're going to get a check every month for $1,000 for the next 5 years. And if they have anything left on the line of credit, so okay, a year later, okay, this $1,000 is good, but hey, I need a new roof. I want to pull $5,000 off my line of credit. They can do it. And if it doesn't affect their term, that $1,000, guess what? They still gonna get that $1,000 and that $5,000 to get the roof fixed. So there's a lot of different options. And they can do a combination of everything. They can do a line of credit with a 10-year payment or a term payment. So the product is a lot of options. So, you know, you definitely want to make sure that you explain all these to the borrower. And like I said, good thing about it, if you got any questions, feel free to give me a call. Either myself or Kevin Brown, one of us can help you with any type of scenario you have. And like I said, if we don't know, we'll go to one of our AEs and get more information for you. Here's the good thing I like about the ARM. It has a growth rate on there. So, like I said, scenario 2.25. And let's say the LIBOR is at 0.75, okay? So I mean at 3% interest rate. So the LIBOR, we all know from our mortgage training that the margin plus the index is the rate. So if the margin is 2.25 and the LIBOR is 0.750, that means the interest rate is 3%. Guess what? The growth rate is going to be the 3% plus 1.25. So they got that. So it's always that cushion of 1.25 on their growth rate. So even though they're getting charged 3% interest, that line of credit is growing at 1.25% above that. And here, let me show you an example. Let me see if I have it up here. Let me see how I'm gonna. see if I can zoom this in. Can you guys see that? Okay. Right here. See, this is the loan balance and this is the line of credit. So you see, if they leave it on there, you see how every year is growing. Every year is growing. This is the property value. They do 4% appreciation. So this is how much equity they have in their home. And I always like to tell people, okay, well, I don't know, that seems right, but you know, I don't want to lose all my equity. Let's say your home does not appreciate at all, okay? And stay at $450,000. You have until year 17 until all your equity is gone. So you live for 17 years in that home not making a mortgage payment, and your equity just not been eaten up. And let's say you never touch this line of credit. Guess what? I mean, this is a morbid view of it, but let's say you come back from the doctor's office, you're 92, and he said, hey, I'm sorry, you got 6 months to live. Yeah, 6 months to live. All right, you haven't touched your line of credit. Your house still at $450,000, you owe $453,000. You have nothing else to leave your heirs, huh? They got $3,000 debt. Wait a minute, I got $116,000 sitting on this line of credit. Even though my house hasn't appreciated, I still got $116,000 on here. Why don't I pull that $116,000 out and give it to my family? And let the mortgage insurance pay the difference. So these are just different things you can do with it. So you see it does grow. And let's say if it appreciates at the 4% like the normal market normally does, they still got equity in here. Look, the home is still going up in value. So when they sell it, the family's still walking away with $352,000, and you know, this $175,000 mortgage that you had, you never had to pay it. So you're still able to give something to your kids or heirs, or if you want to give it to the charity, you want to give it to the cat, it's yours. So so that's why I'm saying it's a good financial planning tool, and you just need to know these different options to work with your clients. All right, so we talked about the 1.25 difference in the growth. All right, so once again, this is only available on the ARM product. All right, and this is a line of credit, okay? It is a line of credit. So in that same scenario that I gave, the person got 2 months to live, they got $116,000 on a line of credit, but they're so distraught, they didn't even think about the $116,000 they got on that line of credit, and they pass away. Guess what? The line of credit goes away. And the $453,000 is what's owed on the loan. So they sell the house for $450,000, and the insurance write it off for $3,000. Which option is better? Having, passing away and having $453,000 owed, or passing away and giving this and having $500-something owed, and your heirs don't have to pay it. So they got the $116,000 and they're doing what they want to do with it. The amount of funds depends on the age of the youngest borrower, the appraised value of the home, the interest rate, and the total monthly obligations. So let's do a couple examples. Normally when I break out my reverse vision, it always want to update on me. So hopefully it's going to work today. So we're going to use a quick calculator. All right, anybody got a birthday for me? What year? How old are you? You gotta be 62 and over. So let's say 1944. 1944. And it's a glitch in here, so I'm probably going to do this over again. I know this zip code right there. Let's say the property value, I don't know why it does that. Let's say the property value is 525,500. And let's say you got a mortgage on here of $145,000. All right, so in this scenario, okay, I understand you got a $145,000 mortgage. Great. What we can do is we can go ahead and give you the reverse mortgage. We're going to pay off that. And at closing, we're going to give you $27,769 in cash to do as you want. But look at this right here. Year 2, you got a line of credit of $122,000. That line of credit is going to grow. And you see right here, you still got equity in here. They talk about the fees, you know, $6,000 origination, insurance fees, and other closing costs. So line of credit have available to them after year 2. So would that be a benefit not have to pay that $1,300 per month? Do you got any plans that you're trying to do? You got any bills you want to pay off? Like I always ask them, why do you even look into a reverse mortgage? You need to find out what the need is before you can sell to the need. One of my other trainings I did last week, we talked about ask the right question. We didn't talk about product at all. But once you get here to product, you need to see, okay, here, I'm taking care of your need. We're getting rid of that mortgage. This might be the borrower right here who might have lost a spouse, so their income got cut in half because they lost their Social Security and other benefits. So now this mortgage is a little more difficult to pay. So they have a savings, but their savings is quickly drying up. So with this, you take care of the mortgage, and they get some much needed cash. And this line of credit, I call this your rainy day fund. It's there. You don't have to use it. If you don't use it, just go back into the equity when you sell the home. But in an earlier scenario, if you're about to sell the home and the home doesn't have the value that you thought it was going to have, and you have all this money on the line of credit, it's perfectly all right for you to pull that money off that line of credit to do what you want to do with it. One of my favorite clients, Mr. Scott. Mr. Scott put all his equity out, paid off his mortgage, and got all his cash. Mr. Scott wanted to go travel through Brazil and all these other exotic places. Mr. Scott was about 83, 84 years old. To this day, he still sends me these emails from different places he's been. But he said, you know what, Glenn? I'm done. I worked my whole life. My son, he got his own life. Whatever I leave him, I leave him. I gave him so much while I've been here, so I'm not going to limit myself when I'm going. I'm not going to limit myself until I go. So like I said, he's in it because he wants to do the traveling that he wasn't able to do. He wants to get the things that he wasn't able to get. He fixed up his house, made it comfortable. He put ramps and things in there. So when he got to a point where he needed those things, he was going to have them there. He was forward thinking. All right, so any questions from the audience right now before I go forward? Did this scenario help you get to see exactly how to put together a quote?
I have a question. So what happens to the equity reverse mortgage?
The equity reserves?
Does that stay there?
That's just there. That's your equity. The interest is going to eat this away. So this is what guarantees you don't have to make a payment because you got equity in there. So, over time, if your value increases, like I said, let's go back over here. Seeing this right here, this is your equity reserve, okay? If your property value is increasing, then your equity is going to increase as well. So you got equity and it's going to steady increase. Here, let me show you an option. Trying to see some of these old loans that we had, some stuff up in there. And I'm going to show you, you know, some people say, well, how you know it's going to appreciate like that? Well, I don't know. No one knows. But let's see what we can find out for you. Come on, Reverse Vision. Come on. Don't let me down. So it looks like it's thinking right now, so that's a good sign. What?
Why do people have negative connotations with reverse mortgage?
I mean, I think it started with the initial product. Initially, the reverse mortgages in the early 80s, it was started by insurance companies. And what they did was they wrote things into those loans saying, hey, we're going to give you a reverse mortgage on to pay, but we get all your equity. So then in I think it was 1986, the Gipper, Ronald Reagan, and Congress passed the new reverse mortgage to where it did not share in your appreciation. You did not have to let's try this one. So what they what it did was, so you didn't share in the appreciation. So any equity that you earn, you got to keep. So okay, I'm sorry, I lost. Okay, so yeah, so the old product, they shared your appreciation. What they did was they passed a law, the new reverse mortgage, where they didn't share any appreciation. So it was just a loan like any other loan. You know, you kept your equity, it was yours. All right, so with this, the appreciation, let's say it appreciated 2%. You'll really say, what's the normal appreciation in this market? About 2%, that's about right. They said national average 4%. So let's go a little below. Let's go 2%, okay? And I'm going to show you what happens to the negative reserve. See, on this one, it's going to go quicker because this person had a big mortgage, which pretty much took care, which was taking all of their equity, or all of their principal limit they had, because they were only getting about $8,900 at closing. So what we're going to do is we're going to look at, because think about it, you can change the appreciation. Because some people say, well, yeah, you're going to give me 4% appreciation, telling me, oh, yeah, I'm going to have all this equity, is my property's not going to appreciate that much. Okay, that's fine. Let's do it at 2%. I mean, if your property's not going to appreciate, then you may as well get a reverse mortgage because you're not going to get anything anyway. So at least get your growth rate where you know you're going to get at least 1.25% above whatever your interest rate is. So let's say at the 2% mark. So the property, see, the equity goes away at year 16 if it only appreciated 2%. So 16 years with a 2% appreciation before all your equity in your home is gone because the interest ate it up. 16 years of not having to make the mortgage payments. I mean, they have to weigh the option. Is it better to make those mortgage payments? Because at 16, they probably, 16 years versus if they're only 5 years into their conventional mortgage, they still got 9 years left to pay. So, is it better for them to have that money for their living expenses, or is it better to pay the bank interest? That's, so these are conversations you need to have with them, because, sometimes you do have to help a person realize, what is going to be the better option for me. Because with a conventional mortgage, we all know with a conventional mortgage, that first 13 years, all you pretty much is paying interest. And see, that's why, and people always say, why they pay more money for a reverse mortgage on the comp? Because with a conventional loan, how many people refinance every 2 to 3 years, chasing the interest rate? They keep refinancing, so the bank is only making money for 2 to 3 years off of them. So yeah, they can't expend that much on the back end. But a reverse mortgage, the bank is guaranteed to know, okay, year 16, we did an initial loan for, where's my initial loan? 152,000. In 16 years, we're going to get 385,000, guaranteed. Because even the house going to water, guess what? They've been paying MI, which is going to pay the bank. So the bank said, we're going to give you the money because it's a long-term investment for us. So does this answer your question where the equity go to, the equity reserve? So yeah, so you see at 2%, and that's a modest. I mean, 2% is very modest, especially in California. Okay, like I said, it goes off the youngest borrower, value home, and the interest rate. So another thing, in the reverse mortgage, everybody's out there who's listening to this, write this down. 5.06. 5.06 is the floor. I'm going to show you something. And this is another place where we're looking at the best interest of our borrowers. I'm going to take another one. All right, if you go with a higher margin that takes them over 5.06, guess what? You're going to get more. So right here, okay. We got the LIBOR. Let's do the annual. Okay. Let's go 2.37. Okay. You see the expected rate, 4.5. That's the expected rate. And that's based off the swap rate, 10-year swap rate that comes out, 10-year swap rate. So they're saying, okay, average interest rate, the most we're expecting to be about 4.5%. Guess what? It's still lower than 5.06. So they're still maintaining more equity. But this is their initial rate. The initial rate is going to be 3.218. Okay? And this is where, like I said, you have to take care of your borrower. You got to take care of them. All right, so, okay, you see how much the line of credit is? If I care only about me and I want to make more money, I'm going to do this. Look at that line of credit. So 180 versus 200. So I took $20,000 worth of equity from them, trying to pad my pocket, because what they do is they on the higher the margin, the more money they're gonna pay the broker. So, like I said, one thing. So any loan that's submitted, either Kevin, Wynn, or myself, we're going to review it to make sure that we are not gouging the customer. Because once again, if I get called before them and I got somebody on this right here and their expected rate is a 5.29, you see that's over the 5.06. Let me see if I can get something right by that 5.06. Okay, you see how this is? Even at 2.87, they're still getting a maximum cash amount. But if I take them here, and it took $7,000 from them. And the whole reason they came out with the new Dodd-Franks, when the whole new compensation, is because people were selling products because they're going to make more money. That's why it's basis points now. That's why you have a set basis point. That's why it's no longer based on the loan amount. You get a percentage of it, because people were thinking about them. They're, thinking about them. Here's the thing, okay? If you want to be that way and rob the customer, let's say you do it right here. Your compensation, let's say $5,000, okay? Let's say the company get $10,000, okay? These are just hypothetical numbers, don't hold me to them. Okay, but you say, you know what, I want to charge them a higher margin. Guess what? You charge them that, you still get $5,000. The company might get $11,000, but it doesn't help you. Okay. Guess what? You still get $5,000. The company get $12,500. The company's already telling you, we are happy with the $10,000 we're going to get. Okay? Once again, we'd rather have more versus gouging customers. Because once again, if you got to step in front of them and they're asking you, why did you give them a 3.12 margin? Why? You have no valid reason to give it to them other than I was trying to get more compensation. And good thing about it, some people out there are giving margins like this because, some of these bigger companies, they have a set margin they have to go with. I always tell them, when I talk to customers, I always come in low. Always come in low. Here, I give you 2.3, I give you 2.25. You preserve your equity more. Oh, well, they were offering you 2.75? Okay, they're giving you 2.75, so instead of you getting 200,000, they're going to give you 194,000. Who gets that extra 6,000? You or them? So, I never want to go in there and go with a highball number just to try and pad my pocket. Because at the end of the day, I'm doing this because I like working with seniors and helping seniors. And I like sleeping at night. I don't want to be not able to sleep at night because I'm gouging seniors for a couple extra bucks that I'm going to have to pay to Uncle Sam anyway. And I'm probably going to lose it somewhere down the line because I did something I shouldn't have did. And believe me, I'm not preaching to nobody at all, but that's just my philosophy on it. I know I'm up in this suit looking like a preacher, but I'm not preaching to you. All right. All right. And the way they're able to do this, not have to make a payment, is the mortgage insurance. Just like on a regular FHA loan, you pay up front, then you pay a monthly margin. You pay a monthly mortgage premium. So here's the thing, where if a person doesn't have a mortgage, they're only going to be able to take out 60% of it. So what's going to is their initial MIP is only going to be 0.5. But if it goes over 60%, more chance of them have to pay a claim out because it's a higher loan balance. The equity is going to be eaten up quicker. So they charge them 2.5 up front. So these are things you look at as well. Third-party costs, appraisal, title, flood, credit, and these are put into the loan. And like once again, going back to California, none of these charges, we can't do any of these until when? 7 days after counseling. I had, like I said, I need a credit report because the person initially wanted to do, they said they didn't want to do a forward mortgage, ran the credit, and it's my fault. They were so gun-ho on the forward, we ran the credit, and they said, I want to do a reverse. All right, we did a reverse, but guess what? I had to eat the credit because they hadn't been counseled yet. So I had to eat the credit in the flood. So you always want to make sure that you wait that 7 days. And like I said, origination fee. A lender could charge a fee up to $2,500 if your value is less than $125, and it can go all the way as high as $6,000. So it does cap out at $6,000. This is only for the adjustable. Once again, on the fixed, there are no interest rates. 5.06, there's no interest rate. If you go 4.99, there's a $1,000 origination fee. But, you know, why even pay the origination fee? If you got somebody who have to be under 5%, they must be under 5%. Okay, you can get that. It's going to cost you $1,000, just like on a conventional mortgage. You got to buy the points down. All right, and we're just going to go through the HECM for purchase. The HECM for purchase are perfect borrowers who are downsizing because they get home is too big, family's gone, they need a one level. They want to be closer to children and grandfather. Another one, they're moving to a 50-plus community. They want more people their age, more activities to do. They want to purchase a home without making a monthly mortgage payment. You know, builders and realtors use this product to sell more properties. Unfortunately, a lot of them don't know about the reverse support purchase because the ones we've been working with, they can do reverse mortgage for purchase? Well, it's a lot of work involved in that. No, it's the same amount of work. It's a little easier, less paperwork we can do. You know, HECM for purchase had the same products, limits, and rates as the regular mortgage. Regular home equity conversion mortgage. You know, the borrower must make some type of investment towards the purchase, meaning that they're bringing cash to this, okay? If you're buying a new home, you're paying for your equity reserve up in there. The reverse mortgage is going to give you part of it, and then you bring another part of it to it. And like I said, once again, only apply to owner-occupied primary residence. And here I'll show you how, on a reverse purchase, how to look with the cash they have to bring. Okay. So on this scenario, why is it not going down? So on this one, this is what the borrower had to bring to closing. Purchase price was $225. They had to bring $120 to closing. So this, like I said, they just closed this loan. They're going to be living in the house, not having to make a monthly payment. And see, no origination fee, but like I said, on adjustable, you know, I don't know, some people they might want to adjustable to the lower rate, you know, a little bit higher they have to bring because they have to pay that origination. But you see right here, no origination fee whatsoever. And like I said, this is good for people who might have just sold a house or got a lot of funds available and they want to purchase a house, but they don't want to make the mortgage payment. So you put it in there. All right, so like I said, there are draw restrictions on both the fixed and the ARM product. You know, both fixed and ARM allow for cash draw, line of credit, monthly payment, or a combination. The fixed hasn't been approved yet. So that just needs to be corrected. You know, ARM is attractive for payment options, but also the line of credit and the growth rate. I mean, like I said, I like the adjustable. Initially, I was scared of it. I didn't understand it because I was selling I was just throwing any margin out there. Okay, the company, I worked at a big company, this is the margin you can sell at. Okay. And then one day I was playing with it, I'm like, well, why did the cash change? Why is the cash amount there getting changed? I don't know, just something, you know, no one can ever tell me anything. Then this one trainer went to one of his classes and he explained to me. And you know, it took him a little while to get into my head because I just couldn't comprehend it. So he stood up there and broke it down to me and he said, okay, Glenn, the floor, just think of the floor, 5.06, anything below 5.06, they get maximum cash. Anything above it is going to reduce the amount they can pull out because the higher the interest rate, the quicker the equity is going to be getting eaten up. And if a person lives for 20 years, 25 years in that home, the interest rate, the equity is going to be gone, as you can see. And what's going to happen? They're going to have to pay a claim. So they're going to charge you. They're going to give you less money up front because they want to maintain the equity. The ARM is, talk about the growth rate, heck of a purchase. It allows you to buy a home and not, a lot of people want to go buy, I'm going to pay cash for a $400,000 home. Why put all your money into it where you can put maybe 60% into it and you still got your other money to where you can live on, you can make investments, you want to start a business, you want to start, any type of business you want to start. Flower delivery business, I don't know. So you can do whatever you want to do. And remember, they never have a mortgage payment as long as they have that loan. The only thing they have to pay is the property tax and insurance, like they would have to pay on any other loan. Like I said, pricing varies, and this is more so on the back end. We went in with a very competitive pricing plan, so we're making sure that we're able to offer customers a good margin, and we can still make a good amount of money off of it. But we didn't go for, that's one thing with Kevin and I we talked about. We didn't want to go for the highest comp plan they have out there, because if we go for the highest comp plan out there, we won't be able to beat anybody on the low prices. And for all you BRE agents, that the low price guarantee. They're taking less points on the back end because they want to be able to beat the low price leader. And like Kevin always said, that $100 guarantee, he hasn't paid out $100 thing yet, because he's always going to be able to be the low price leader, because he's taking less compensation on the back end so he can give it to the customer on the front end. All right. All right. So that concludes it. Okay. Any questions for me? I'm gonna look for a couple more things in here real quick. But any questions about the slides or anything about products? Any examples you need to see? And you talk about paperwork. This is type of arena we in. This is the application. How many pages is this one? 244 pages. And so it all goes down. Because you got the part that we need them to sign, and we also have the part for them. So like I said, it's a lot of information. This is a proposal. You can give them, if you want to give them an official proposal. How many pages is that one? I think that was 90 something. So, this, if you want to give them a proposal, here's a proposal, get your information on there. 94, yeah. And the reason the proposal got so many pages is because there's a booklet in there. Use your home to stay in your home. And I always, when they get down email, I send them a proposal. So, because what's council gonna ask, did they give you the book, Use Your Home to Stay in Your Home? I send it to them on email. And I give them their own proposal up front. So I'm covering myself. I mean, chances of them reading that whole book is pretty much slim to none. I read a few pages of it, but, it's pretty much talking about the program, different options, but they must get this before going into counseling. So all you need to do is run off a proposal and send it to them. And like I said, within that proposal, and so when they go to counseling, your counselor is going to say, hey, I need your loan docs. Okay, here you go, counselor. Go to this website right here. Enter this code. It's going to bring up all my loan docs. It's going to bring up the products that I recommended. It's going to show them. You know, they chart them a couple different things I'll show you. Amortization chart, the comparison. See right here. See, so the counselor is going to have all this. So when they're talking to the borrower, they're going to ask some questions. They're going to be like, okay, Mr. Johnson, I see that they get you in the LIBOR, not LIBOR, line of credit adjustable, 2.37. Well, did they talk to you about the fixed rate? Well, yeah, he told me. Because guess what? Every quote I give out the annual, I give out the monthly, and I give out the fixed. And if I'm offering the fixed up front, it's the fixed, the annual, and the monthly. So this way, all the options are lined out right here. See? The cap rate on this, 7.9. So most it can go up is 5%. But on this monthly, it can go all the way up to 12%. So that's what I'm saying. I'm giving them this because I'd rather give them the best product versus give myself the best product.
What's the most common product?
It all depends on the scenario. I mean, probably right now, it's probably the adjustable because of the line of credit. If they have any type of equity, they're going to go with the adjustable because they want to be able to pull that money here too. Right now in the fixed, once you pull it out, like his example, let's say, do you have anything? Okay, let's say if he wants this fixed, see, he's going to get the $27,000 right here. That's it. But if you go with this one right here, he's going to have an additional $57,000 that he can draw on year two. So, but if he had a bigger mortgage, says the mortgage is a little higher, and it ate all this up because right now he's only utilizing 79% of what's available to him. If he's utilizing between, more than 90%, then probably want to go with this one because you're going to save him the origination fee and give him all the cash up front. So that makes sense on that? Because remember we talked 10%. So look, he's using 67% of his money right here. He get additional 10% because he's over. And this is his cash up front. Same cash all the way across the board. But once you get down here, it's the line of credit, which is the difference. See, it's NA. See, unavailable principal limit. He'll never be able to pull that out. All right, so let's open it up for questions. Any questions from the audience? All right, it is 8:02. So if we have no more questions, I'm going to go ahead and end the training. And once again, let me put this up for you. Any questions? Feel free to reach out to me on email or give me a call. I'd be more than happy to help you with any scenarios. All right, so if there's no more questions, we're going to end the training tonight. I'd like to thank everyone for attending, and have a good night.